Welcome back to our channel, Nevesta Videos. Today we're talking about government bonds, comparing Euro bonds with African bonds. We'll explore their rates, advantages, and how you can invest in them. But first, let's understand what government bonds are and why they're an attractive investment. Government bonds are debt securities issued by national governments to finance public spending. They are considered low-risk investments because they are backed by the issuing government's credit and typically offer fixed interest rates. Euro bonds are issued in euros by governments within the Eurozone. They are renowned for their stability and are often perceived as safer due to the economic strength of Eurozone countries like Germany and France. Euro bonds usually offer lower yields compared to emerging market bonds but provide greater stability. African bonds, on the other hand, are issued by governments in African countries with return rate as high as 18% annually. They can offer higher yields due to higher perceived risk, but also present more volatility. African bonds can be attractive for investors seeking higher returns, though they come with higher risk levels compared to Euro bonds. Euro bonds are generally considered to be more stable and less risky than African bonds. This is because European countries tend to have stronger economies and more stable political systems. As a result, the interest rates on Euro bonds are typically lower than those on African bonds. However, this does not mean that Euro bonds are always the better investment option. African bonds can offer higher interest rates than Euro bonds, which can be attractive to investors looking for higher returns. However, these higher interest rates come with increased risk. African countries are often more vulnerable to economic and political instability, which can impact the value of their bonds. As a result, investing in African bonds can be riskier than investing in Euro bonds. When it comes to buying government bonds, there are a few different options available to investors. One option is to purchase bonds directly from the government issuing them. This can be done through a government bond auction, where investors bid on the bonds they want to purchase. Another option is to buy bonds on the secondary market, where bonds are bought and sold after their initial issuance. There are several advantages to buying government bonds. One advantage is that government bonds are generally considered to be a safe investment option. This is because governments have the ability to raise taxes or print money to repay their debts, making it unlikely that they will default on their bonds. As a result, government bonds are often seen as a low-risk investment option. Another advantage of buying government bonds is that they can provide a steady source of income. Most government bonds pay interest to investors on a regular basis, providing a reliable income stream. This can be particularly attractive to investors who are looking for a stable source of income in retirement. In addition, government bonds can be a good way to diversify a portfolio. By investing in government bonds from different countries, investors can spread out their risk and reduce the impact of any one country's economic or political problems on their overall investment portfolio. Overall, both Euro bonds and African bonds can be attractive investment options for investors. Euro bonds are generally considered to be more stable and less risky, while African bonds can offer higher returns. When deciding which type of bond to invest in, it is important to consider the interest rates, risk factors, and other factors that may impact the value of the bonds. By carefully weighing these factors, investors can make informed decisions about which government bonds to buy.